We're about to challenge one of the biggest myths in trading. It's something you've probably heard 1,000 times, and it might be costing you money.
This quote gets to the heart of a common trading mistake. Let's look at a scenario that I'm sure many of you have experienced.
You've spent hours analyzing the charts. You've identified the perfect entry point, and with a click of the mouse, you're in the trade.
On paper, it's flawless. The kind of trade you screenshot before it even plays out.
Everything is aligned. You've got a textbook set up, the trend is clearly in your favor. It's the kind of trade you dream about. But then, the market throws you a curveball.
The explosive move you were expecting just doesn't happen. Instead, you're met with absolute silence from the market. The price just churns. It nudges up, teasing you with a small profit, then trickles down, making you sweat. It's this constant, frustrating back and forth that goes absolutely nowhere.
And so you wait. Hours turn into a day, maybe more. You justify the wait, telling yourself that your thesis is still valid, it just needs a little more time to play out.
But deep down, a different voice starts to get louder. It's the voice of doubt, questioning your decision, questioning your skill.
That's the moment doubt creeps in. You see others posting wins, catching big trends, and you're left wondering why your trade is stuck in the mud.
Now, this is the real issue, and it's what trips up so many traders. We're taught to fear the big sudden losses, but the real silent killer of trading accounts isn't always a sharp loss. It's the slow drain of your most valuable resources when a trade just goes nowhere.
That's called opportunity cost. It simply means while your money is stuck here, it can't work somewhere else, on a setup that actually is moving.
Professionals understand something beginners often don't. Time is a critical component of every single trade. It's not just about the price level, it's also about the duration.
And this is the core mistake that's so easy to make. You thought you were being patient, but in reality, you were being passive. And there is a huge difference.
Let's break this down. Patience is actively following your plan. It's disciplined. Passivity is just hoping, wishing for the market to do something, anything without any real structure.
This is a massive shift in perspective. If you expected a strong reaction from the market at a certain point and you get nothing, the market is telling you something important.
Exactly. The lack of movement isn't the market punishing you, it's giving you direct feedback that your thesis might be invalid, or at the very least, untimely.
When you're passive, your capital gets locked up in these grinding sideways markets, like a ship stuck in the ice. It's unable to move, unable to be deployed elsewhere. It's a silent trap.
But with a structured plan that accounts for time, your capital stays fluid, like a river flowing to the sea. It can be quickly reallocated from a dead setup to one that is actively moving, allowing you to catch the trends and ride the waves of the market.
So, how do we fix this? The correction is simple but powerful. You create a clear, simple rule.
Here it is. If price hasn't moved meaningfully in my favor after a set number of candles or hours, I will reassess or exit. Now, you define those blank spaces based on your trading style. A scalper might use a time limit of a few minutes, while a swing trader might use a few hours or even a full day.
The key here is that this isn't a rigid emotional reaction. It's just a structured boundary. It's a logical checkpoint in your trading plan.
And implementing that, one single boundary, is what frees you. It removes those silent capital traps and keeps your money working for you efficiently.
Save this explainer. The next time you find yourself in a trade that's going nowhere, revisit these slides. It can be the reminder you need to make a structured, unemotional decision.
And finally, follow this channel for more simplified trading concepts just like this. The goal is to stop thinking that trading doesn't work and start building a real understanding of how it actually does.